Between December of 2020 and June of 2022, there was essentially no price correlation between the 10-year Treasury note and foreign currencies. However, from July of this year through the first week in December, we've seen a much stronger positive correlation between these prices, suggesting that as Treasury yields rise, the demand for US dollars and its value relative to other currency also increases. With that as a backdrop, we use CME CVOL Indexes to look at what the foreign currency options markets are indicating as we head into the next CPI release and the December FOMC meeting. The graph shows the CVOL level and skew of the aggregate foreign currency basket, which includes the CAD, the yen, the euro, the pound, and the Aussie dollar. After the spike higher during the initial COVID-19 lockdowns, volatility in currency options traded in a narrow and historically low range for most of 2021. However, once interest rates began to rise to combat inflation, volatility in the FX markets traded materially higher and remains there today as we look toward these next two market events.
The US dollar has steamrolled every other major currency this year due to widening interest rate differentials, safe haven flows, and quite frankly, an absence of attractive alternatives or best in class. And as Craig said, the correlation and volatility between Treasury prices, the demand for the US dollar, and its relative value to other currencies has also increased, such that calls and puts are trading at similar volatilities as we head into the last major economic releases of 2022. CVOL and Treasury prices and yields shows us that though we are not at the highest levels we've seen over the last 6 months, we are still near the upper range. The beta or correlation in CVOL for major currencies like the yen, euro, pound, Canadian dollar, and Aussie dollar also shows a similar pattern.